The market for Beyond Meat, ticker BYND, is closed. The closing bell on Friday, October 31st, 2025, locked the price in at $1.66. That was a tiny gain for the day, up about half a cent, with a fractional after-hours bump following. But that $1.66 price is deeply misleading. If you just glanced at this stock, you'd see a failed company, a busted IPO, an asset trading for pocket change, clinging to life just above its 52-week low of 50 cents. That is the expectation. You'd assume this is just another forgotten, beaten-down name in a portfolio you'd rather ignore. The reality is that this $1.66 price tag is the aftermath of one of the most violent and deceptive market events of the year. This isn't a stock quietly fading away. It's the wreckage of a rocket that exploded on the launch pad just days ago. Only 2 weeks ago, this same stock was the talk of Wall Street, the #1 holding in the Roundhill meme stock ETF, as it rocketed from its lows near 50 cents to a staggering intraday high of $7.69. That was a surge of over 1,400%. For one brief, shining moment, the expectation was that Beyond Meat was back. The squeeze was on, the shorts were trapped, and the Walmart deal was the catalyst for a new future. Today, at $1.66, we are staring at the brutal reality. The rocket has returned to Earth, and the landscape for this company has been permanently and catastrophically altered, not by the short sellers, but by the company itself. To understand what happened, we have to look past the one-day chart and see the war that just took place. The common belief was that Beyond Meat was a simple short seller target. The company was bleeding cash, sales were declining, and the entire plant-based food category was facing a consumer backlash over price and taste. Short sellers had piled in, with short interest soaring to over 60% of the entire public float by the end of September. It was a classic, high-conviction bet on failure. The borrow fees to short the stock were astronomical, peaking at over 130%. The stage was set for a squeeze. Then the catalysts hit. In mid-October, the company announced a massive, complex debt-for-equity swap. The market, at first, interpreted this as a positive. Bankruptcy risk was off the table. The company was cleaning up its balance sheet by exchanging its convertible notes. Almost immediately after this, on October 21st, Beyond Meat announced an expanded partnership with Walmart, increasing its distribution to over 2,000 stores and, critically, introducing a new, lower-priced value pack. This was the 1-2 punch. The no-bankruptcy narrative combined with a growth narrative from Walmart sent the stock into a frenzy. Retail traders piled in, the meme stock ETF added it, and the short sellers were torched. We saw trading volumes explode to over 1 billion shares in a single day. The stock screamed from under $1 to over $7. The expectation was that the retail army had won. But the reality of that debt deal was far darker. It wasn't just a simple cleanup. Beyond Meat didn't just exchange debt for new debt, it exchanged it for up to 326.2 million new shares of common stock. Let that number sink in. Before this deal, the company had a share float of around 77 million shares. The company's management, in a desperate move to save the corporation, issued more than 4 times the entire existing public float. They didn't just dilute shareholders, they orchestrated a flood of biblical proportions. This move was the ultimate reality check. As the stock was squeezing, the company was creating a massive new supply of shares to hand over to its former noteholders, who could then dump them into the rally. The short sellers who were trapped, they were just handed 326 million new shares to cover with. The squeeze was snuffed out not by a hedge fund, but by the very company investors were trying to save. And so here we are at $1.66. The rally is dead. The 52-week high of $7.69 is a distant memory. The market cap, which briefly ballooned to over $1 billion, is now languishing. The $654.1 million figure on some trackers is in flux, but the reality is this is a company valued in the low hundreds of millions, possibly as low as 140 million to 220 million, depending on how you count the new massive share count. The PE ratio is non-existent because there are no earnings. There is only a sea of losses. Analysts at places like Mizuho and TD Cowen saw this dilution for what it was and promptly cut their price targets to $1.50 and even 80 cents respectively. They recognize that the fundamental story is not only unchanged, but arguably worse. Let's talk about those fundamentals, the reality that was ignored during the short-lived squeeze. On October 24th, right in the middle of this chaos, Beyond Meat released preliminary third-quarter results. They were not good. The company expects revenue of about $70 million, continuing its downward trend. Gross margins are pathetic, hovering around 10%. Worse, the company warned it would be taking a material non-cash impairment charge. This is accounting language for some of our assets, our factories, our equipment, are not worth what we said they were worth. This is the opposite of a growth story. This is a story of a company shrinking, writing down its past investments, and struggling to find a market. The entire plant-based category is in a state of collapse. Data from earlier in the year showed U.S. retail sales of plant-based meat falling over 7%, with the critical refrigerated segment, Beyond Meat's home turf, dropping over 12%. Consumers are tired. They are tired of the high price, especially in an inflationary environment where real meat is often cheaper. They are tired of the taste and the texture. The initial hype of a one-to-one replacement for animal protein has met the harsh reality of consumer preference. The Walmart deal, while positive for visibility, is also an admission of this. The new product is a value pack. This is not a premium high-margin product. This is a company being forced to compete on price, a game it cannot win given its high operating costs and negative margins. This brings us to the short-selling situation as it stands now. The war is over and the shorts won, aided by the company's own dilution. The short interest as a percentage of the float, which was over 60%, has collapsed. With the float expanding by over 400%, that 39 million share short position is now a much smaller percentage of the new massive float. The most recent data from mid-October shows the short float percentage dropping to around 13.5%. The days to cover, which had been in the double digits, plummeted to just 1 or 2 days. The borrow fee, which was at 130%, is now at a manageable 5.7%. There is no squeeze left. The fuel has been spent, and the shorts have largely moved on, either having covered during the panic or waited for the dilution to hand them an easy victory. What's your take on this? Do you think the company did the right thing to save itself, even if it meant destroying the rally and diluting existing holders? For investors, this is a treacherous landscape. The first actionable step is to understand what you are looking at. You can find short interest data on platforms like Fintel or Ortex, or even from NASDAQ itself. But you must interpret it in context. A high short interest percentage is meaningless if the company can simply issue 300 million new shares. You must watch the share count. You must also monitor the fails to deliver, or FTD data. Just before this squeeze on September 30th, FTDs spiked to 8.7 million shares. This was a clear signal of market stress and settlement failures, often a precursor to extreme volatility. But again, these signals are now historical. The primary risk here is no longer a short attack. The primary risk is fundamental insolvency and further dilution. Retail sentiment, as seen on forums across X and Reddit, has understandably shifted from euphoria to betrayal. The same investors who cheered the debt deal as a positive are now realizing it was the very instrument of their demise. The conversation is no longer about diamond hands or squeezing the shorts. It's about class action lawsuits, anger at management, and questions of survival. The company's upcoming earnings call on November 4th will be one of the most hostile in its history. Investors will demand answers about this dilution and, more importantly, about the core business. So, what is the future outlook? The bear case is simple and overwhelming. The company continues to burn cash, with a net cash use of $59.4 million in the first half of the year. Sales continue to decline as consumers abandon the category. The new, lower-priced products at Walmart fail to gain traction and only succeed in crushing their already thin gross margins. With a delisting risk if the stock stays under $1 for too long and a balance sheet shored up only by diluting its owners, the company bleeds out, eventually filing for bankruptcy or being sold for pennies on the dollar for its brand name. The 52-week low of 50 cents is not just a historical marker, it is a very real possibility. The bull case, the path back, is almost impossibly narrow. It requires a miracle. It would require the new products to not only succeed, but to be wildly profitable. It would require a major new partnership, far bigger than the fast food trials we have seen in the past, to commit to a permanent national rollout. Or it would require a technological breakthrough in their food science, a new version of their product that is simultaneously cheaper than animal meat and indistinguishable in taste. Without one of these, the only other bull case is a buyout.
At this low market cap, a food conglomerate like Nestlé or Unilever might decide the brand name and patents are worth acquiring. But they will not pay a premium. They will wait, let the company bleed, and pick the carcass clean. Comment below with your thoughts on this. Do you think the plant-based meat trend is officially over, or is this just a temporary downturn? In the end, the story of Beyond Meat in October 2025 is the ultimate lesson in expectation versus reality. The expectation, fueled by meme stock fervor and headline news, was a triumphant victory over short sellers and a return to growth. The reality is that this was a corporate survival tactic disguised as a rally. The company used the investors' own enthusiasm as exit liquidity to execute a dilution of staggering proportions, saving the corporate entity while destroying shareholder value. The $1.66 price is not a cheap entry point.